Welcome to the M&A Unplugged podcast. Our mission is to help you be better prepared for your business acquisition or sale. Being prepared will ensure you maximize returns and minimize risks. This is M&A Unplugged with your host, Domenic Rinaldi.
Welcome back. I'm Domenic Rinaldi, host of the M&A Unplugged podcast. I'm pleased to welcome back Scott Becker to our show. Scott is a partner with the law firm McGuire Woods. He's also the founder of Becker's Healthcare Review, as well as several popular podcasts. He's a busy man, and I was glad to grab a few minutes of his time to discuss what is happening in the private equity sector. One of Scott's podcasts is focused on private equity, and he routinely interviews principals of private equity firms, as well as attorneys and accountants that deal with private equity. Scott is a wealth of knowledge, and in this episode, we touch on the unbelievable activity we are seeing in the market, forecasts for private equity deals going forward, how business owners can be better prepared for a private equity deal, and how to properly vet private equity firms that express interest in acquiring your firm. Scott shares some incredible nuggets that will help you better understand the private equity world. I know you'll love hearing his perspectives. Before we get into the episode, however, we've created a best practices and checklists for how to conduct due diligence. This is a free resource available on either of our websites, sunacquisitions.com or k2advisor.com. Take a minute to download this invaluable resource. It's a great starting point for you and your advisors when contemplating an acquisition. Thank you for being here and hope you enjoyed today's episode. Hey, Scott, welcome back to the show. Pleasure to have you here.
Domenic, always a great pleasure to visit with you. Thank you for having me. You do a remarkable job.
You know, you're such a busy guy. You have so much going on, evidenced by the fact that you've, pulled over in your car to do this interview. And I'm so grateful that you've taken some time to do this. And you've been on the show before. We've dove into some other topics, but today I really want to spend some time visiting with you about private equity. You've got a very successful podcast, the Becker Private Equity Podcast. And I know you meet with a lot of principals of private equity and a lot of associates in the legal profession that deal with private equity all the time. And so I really want to dive into private equity and what's going on there and maybe what the future holds. So without much further ado, let's dive in. 2020, what a year, huh? I mean, it was a tale of 2 years, right? You saw the first half, everybody sort of just hold on for dear life, wondering what's going on. And then the second half come roaring back and, eclipse what had happened in the second half of 2019. What do you make of that? And what do you think that means for the future here with private equity?
Sure. So 2020, of course, was a fascinating year. And I've been watching. We started a private equity conference about 18 years ago or so in the healthcare sector. So I've been sort of watching the private equity sector for a very long time as it's grown from being a small monopolized sector by a handful of huge funds into a very, very sprawling area with lots of different players, lots of different investors. 2020 was, of course, a remarkable year. If you look at the second and third quarter, most professionals that dealt with private equity ended up a little bit slower, whether you're lawyers, bankers, if you're doing sell-side diligence, if you're the Marwood Group, whoever it is, and not to mention specific names, they might have been very busy themselves, but most people ended up some point at the second, third quarter a little bit slow as the pandemic sort of messed up the entire world. You had this huge gulf of sellers needing funds, but not wanting to yet decrease prices greatly. Buyers wanted to put money to work, but totally unsure about what the world was going to look like. By sort of the end of last year, the world had somewhat at least rationally stabilized. Still a mess, of course, from a political standpoint, still a mess from a COVID standpoint, but consequently, as the world started to stabilize some, and people said, we're going to survive this, it's going to be okay in some way or another, the deal world rebounded dramatically. So I would say that most deal professionals, more private equity funds, had a crazily busy last quarter of the year, all the way till quite frankly, December 31st, and people very busy, very much across sectors. I mean, it went from people being worried about sitting on their hands for months to being crazily busy and lots of deal activity getting done. The fascinating thing about it was, if you went back the last couple of years, it was all sort of mega deals. Last year, I would say towards the end of last year was tons of middle market deals, tons of small to mid-sized deals, everybody very busy in just a fascinating sort of environment to work in. I mean, obviously, independent sponsors I'd say a little bit differently, because trying to figure out new deals with independent sponsors a little bit differently. Family offices busy, but then traditional private equity funds that have committed funds very crazily busy towards the end of last year.
Yeah. Were you surprised at what happened with valuations? The reports that I have read is that valuations continued to increase throughout the end of last year, and it was sort of a bit surprising. Now we could talk about maybe the deal structures, and maybe that's because there were more earnouts versus maybe seller notes or more cash at closing. But surprising to hear that valuations continued to increase through the end of last year. What's your perspective on that?
Well, I think what you ended up with, it's a great question. You ended up with two different types of deals. You ended up with deals that people think of as quote unquote COVID resistant, that were pandemic resistant. Yeah. Businesses that flourished in sort of this challenging environment. And those businesses, there ended up being in total a smaller percentage of those, but enough of those, but those commanded great valuations because they showed themselves to be stable through this pandemic era. And so those were, people looked at that and said, aha, this is like recession proof. Other types of businesses that got hurt by the pandemic largely had to take themselves off the market for the year because they couldn't find pricing anywhere near that delta between what a buyer would pay and a seller would pay. So you have this sort of like this percentage of deals that were COVID resistant that commanded great multiples, and people were looking to put money to work and get into these sectors so they didn't miss the opportunity. And then you had deals that were not COVID resistant that basically didn't get done last year.
Yeah. Okay, very, very good point. You hit on it. You hit on this idea that, pre-2020, there were a lot of mega deals, and then you saw the middle market really light up last year. One of the trends that I've seen in our market, and we focus on, lower middle market deals, one of the trends that we've seen really heat up over the last, I'd say 5 years, is private equity taking a really active role with their platform companies in going out and making additional acquisitions, adding on and really going pretty far downstream in some of these deals. In fact, we did a deal last year with a private equity group that had an enterprise value of $2 million. 10 years ago, that would have never happened. And we're seeing more and more of that. Do you think that's a trend that's here to stay, or you think that was just because, people were just looking for deal flow in a pandemic year?
Yeah, no, it's a great question. So a ton of the work that I live in is in the healthcare space. In the healthcare space, the whole business model is bolt-ons. And the bolt-ons could be very small. If you're working with a dental practice platform, they are either only going to be adding on big other dental practices of significant size, or they're looking down to the ones and twos and threes to try and build out a bigger system. And sometimes they're making their money on the management information systems and other kinds of ways and so forth. But you see that. You see some, we saw an ophthalmology platform that tried to do 40 to 50 different deals last year, many of those quite small, trying to add on lots of small practices. And what happens is, to do it, you have to get quite efficient in your practice and your processes. It just doesn't make sense to do $2 million deal, or even some of these deals are $800,000 deals, unless you're very efficient. And here's what the employment agreement looks like. Here's what the deal documents look like, because you could spend so much time negotiating for what's ultimately a very small deal.
Yeah. Well, this is great. I'm going to put a placeholder on this because I want to come back to what owners should be thinking about when private equity comes knocking on the door, and people that were thinking they might not have been, private equity target, I think should start thinking differently about that, because I agree with you. I think this trend is here to stay. I think larger deals are fewer and far between. They're harder to come by. And you've got all these smaller deals out there that are easy bolt-ons. And I think that trend is going to continue to heat up. So, but before we get there, I want to talk about 2021. So what do you see happening? Let's pull out the Becker crystal ball here for a minute. What do you think is going to happen in 2021 with private equity? And then the secondary question of that is, do you see regulation coming into play, and how is that going to affect private equity?
Sure. So what's happened with the world, and again, some people are different. In terms of prognostication, I feel like over the years, it's gotten harder and harder to prognosticate intelligently and well. Last year I was betting I would have seen deal flow fall apart. I would have seen the stock market back at 18 to 20,000, and a number of trends happened that changed that dynamic significantly. Interest rates ended up at zero. The stock market ended up inflated. Deal flow came back with a resurgence at the end of the year. So prognosticating is hard to say. What I can say is the deal world is very, very busy currently. I'm right now invested in, with a large private equity fund. They just sent out capital calls yesterday because they've got some deals to put money to work for commitments, to meet our commitments, stuff like that. And it's just indicative of what we're seeing out there. The law practice, I'm still a partner at McGuire Woods, have been for 30 years. The law practice is quite busy. People that lead that practice, whether Jeff Cockrell, Tom Zom, Amber Walsh, Holly Buckley, are very busy. And there's the thing that is interesting is private equity funds have so much money committed to them, and they have an institutional incentive to want to put that to work, because they don't have their business without it. So there's really this built-in institutional pressure towards putting it to work. And so they have to really feel like the universe is falling apart, not to try and put money to work. And there's the numbers out there are astronomical, but we'll talk about $2 trillion in commitments, for just the private equity side, not even the debt side. Yeah. So there's so much money committed to be put to work out there still that it's hard not to see it staying at least reasonably healthy for some period of time.
Yeah.
The regulatory side of it is, I don't know what will happen on the regulatory side, the true regulatory side, the true sort of like what's happened is private equity has become such a huge asset class. The biggest investors in private equity are not rich people. They're not the 1%. The biggest investors in private equity are the huge pension funds, the huge teachers' pension funds, the CalPERS of the world, all these pension funds, and then endowments as well. But those are the biggest investors in private equity. So if you end up every time, you ask private equity leaders why a great percentage of private equity leaders would lean politically blue, and they may or may not, but many of them lean politically blue because their biggest investors are big union pension funds. So you have this very convoluted politics around all this stuff. You've got on one hand the Elizabeth Warrens of the world taking shots constantly at private equity funds, but the reality is the biggest investors in private equity funds are not fat cats. Yeah. It might be fat cats that are running the private equity funds, but it is unions and teachers' pensions and others, police pensions, fire pensions. Those are the biggest investors in a lot of the private equity funds. Yeah. So when you talk about this, there doesn't end up being as much motivation to kill the private equity funds when you get past the surface as there otherwise would be.
Got it. Oh, that's a great point. I mean, so, if regulation comes down, that's going to impact returns, which is going to impact all of these pension funds, and that impacts, the masses of our economy, right? So
that's right. The state pension funds are huge investors in these. I mean, that's where the money really is. The big funds are selling themselves to state pension funds.
Yeah, yeah.
So it's a fascinating situation. I mean,
that said, if you had to bet, do you see regulation coming in this world? You see more regulation, or you think?
I mean, there may be more, but you do have a split Senate. You've got a Congress that's very split. You've got but you do have on the Republican side too, this populist surge that could be anti-private equity too. Yeah. But it's become such a huge part of the investing world, and there's no going back. I mean, it's not like you're going to go back to being 8,000, 10,000 publicly traded companies, at least not in a short period of time. Yeah. It's a private equity is a big part of the universe. You you are primed at some point to have some tax increases. But you might not even have the fiscal discipline in DC to do that, even if people like me who are generally anti-tax raises, but we've put $7 trillion in debt on the last 4 years. We've literally added $7 trillion. And that's, COVID might have added $3 trillion on, but even before that, we had done tax cuts and no discipline on spending. So you're in a spot where you are likely at some point to see tax raises, but we'll see what the discipline is for it and how big and all those kinds of things.
Yeah. Those are great points. All right. So Scott, let's shift over to business owners and what they should be thinking about. And I'm telling business owners every day that, there's a possibility we're going to find a strategic that is private equity backed that's going to be interested. And the level of scrutiny is going to be much higher than maybe they even thought. But what's your advice to business owners who might have a shot at attracting private equity, whether it's directly or through a platform company and private equity is behind that deal and steering the acquisition?
Right. I mean, it's a great question. And you and I know that 10 years ago when you went out to market, it was 50, 70% strategics, 20, 30% private equity. And that's really been flipped today, almost at all size deals, where every deal, directly or indirectly, has private equity competition in it. Even if you want to sell to a strategic, there's just as good a chance you're selling to private equity. So they have the funds, they have the money, they have the debt. They just can outperform on price so well.
And they have the engine. They have the engine, right? I mean, they've got the machine. They've built it. They know how to do these things. They're efficient. They go fast.
That's exactly right. So what happens with the private equity is, the most important thing I always say to a business owner is, first and foremost, make sure you keep your eye on the ball of running a profitable business. Because if you have a profitable business, now you're not held hostage to a process. You're not held hostage to whoever is buying you. Because if your business starts to go in the wrong direction during a process or while you're thinking about a process, you're very vulnerable. So the first thing I say is keep your eye on the ball of the business. The second thing I think about, everything today, it goes in terms of both, core cash flow, but scalability. So are you in a business that has some scalability is sort of the second issue. Are there ways to look at it where it's scalable beyond, more widgets in, more widgets out? Is there some scalability? Is it bigger customers? Is it through technology? Are there other ways to make a business more scalable? The third thing I look at is it a sustainable business? Are there ways to make it more sustainable, more consistently sustainable where it looks and feels that way? The fourth thing is you have to have good accounting systems in place, because you don't want to get to a spot where you're going to do a deal and you've got to spend a fortune with accounting firms and others to get your accounting up to speed. And so most businesses, smaller businesses, are run on a cash basis. Private equity in the real banking world works on an accrual basis. At some point, you don't have to do it, but if you do a deal, you're going to have to do a cash to accrual transition, and that could be hard or easy depending on what kind of business you're in. So I look at sort of four things. Make sure the business is going great. Look at it as a sustainable business. Third is look at it as a scalable business. And fourth is you got to ultimately have your accounting and everything else in order. And then, of course, Domenic, there's a few other things we think about when we think about deals. It's, do you have a great advisor, of course, like a Domenic Rinaldi? Of course, that's important. But do we also think about, in terms of when we're a seller, are our sellers, particularly if it's not just, if there's one seller, is that seller clear about what he or she wants? If it's a group, is it a team, is it a board? Have we gotten our own side on the same page? What are we looking for in a transaction? Mm-hmm. The second part is getting a buyer that's on the same page with you. And the third is just the process to ultimately close the deal. But we sort of look at those three things.
Got it. If I could add, and you can tell me if this isn't appropriate, but the one thing that I would add to that is I also tell owners to try to create, as much as they can, a self-managing business, a business that isn't reliant on them day in and day out. Because the more they are the business, the more risk there is for a private equity group or anybody else coming into the deal to take that over. And so I really urge my owners to try to relieve themselves of as much of the day-to-day operations as possible. I think it makes for a smoother transition for sure, and I think it also increases value.
Well, there's probably no better point than that. I mean, what happens is it's very hard for entrepreneurs to take this advice, But at the end of the day, if they make themselves dispensable or replaceable, they create a much higher level value.
Yeah.
Because the new buyer doesn't see it as though, oh my goodness, we're totally dependent upon this person.
Right.
We're not dependent upon a business, and it's fragile. You got a single point of failure if you got a CEO leader that the business is totally dependent upon.
Yeah.
So it's magnificent advice, of course.
And I think your advice about the financials is so spot on. Having our firm has done, we just eclipsed 400 transactions. And, in all of that time, 20 plus years now, I think we've seen audited financials like 3 times. And the financials are usually in such disarray. In fact, when owners come to us, oftentimes we have to slow them down so that we can have them go back and really build a financial package that makes sense. And your point is so well taken. Pay attention to your financials. Get a true professional in there. Get them GAAP compliant if you can. Pay attention to your balance sheet. Make sure that the balance sheet items are correct. You're not doing plug numbers. Private equity is going to expect that. And if they don't get it, it's going to slow down the process. They're going to do equality earnings anyway, but it's going to make it so much harder to get the deal done if you haven't done all the right things up front with your financials.
That's right.
So, Scott, as you and I both know, private equity is this term, but it's a catch-all. There's so many different flavors of private equity now, right? There's true traditional private equity, as you mentioned earlier. There's sponsors. There's guys that are pooling money together. There's folks that are have committed capital, but it's not there. They draw down and they make calls. How should owners evaluate a group that's expressing interest in them and saying they're a private equity group? What are the things that they should do to vet that group to make sure that it's really a quality group?
Sure. And obviously, Dominic, this is where a group like yours is so important, because if you're running a process and you come down to 12 to 15 potential commitments, 5 to 7 letters of intent, 5 to 7 serious buyers, what you're sort of looking at is several different factors. You're looking at, of course, what is the price and value of the deal? What are the economics of the deal? Then you're looking at, does the fund or whoever you're working with have a reputation for closing deals? Do they actually get deals done? Because it's no good to sign a letter of intent, and obviously you guys in the investment bank world get very good at being able to sort of scent this out. Are they actually good at closing? Are they people that close their deals they sign on to letters of intent with? And the third issue you look at is, do people like working with them? Mm-hmm. And you have to really do some serious talking to other portfolio companies there to understand, have people had good experiences working with them? And again, private equity funds come in my mind, 2 core different flavors that are committed funds, serious committed funds. They come in what I think of as transformational funds. And a transformational fund is one that's investing with the idea of, we're going to very quickly try and merge you with others, build this into a different thing, transform the company. There are other types of private equity funds that are more, I would say, investors / board members, but not trying to do a transformative thing with your company. Maybe bolt-ons, maybe add-ons, but ultimately trying to run the business, help you expand the business, help you grow the business, but they're not truly trying to take it from 1 to 1 as 3. And they're very different flavors, and you have to figure out, what is it you as a seller, what are you looking for? So I look at 4 things: value, the reputation of them as closers, the reputation of them as people to work with, and then fourth, what is their approach? Are they sort of just steward managers with you, or are they a transformative fund? And if they're a transformative fund, either one of these can be fine. It's a matter of what you're looking for as a seller, but they're very different.
Yeah. Those are tremendous points. And I would just take your point about, are they going to be good to work with, to a step further. More and more deals, we're seeing that the private equity groups want the owners to roll over some equity and stay involved. And that's become, I'm seeing that, a high percentage of the time now. And so that's so critical. If you can't see yourself working with these people, for 2, 3, 5 years, that's going to be a rough go. And you could lose value, and all sorts of bad things could happen. So it's a point very well taken. Hey, Scott, again, I'm so grateful and thankful you could be here today. Any parting words that you would have for the M&A Unplugged community about private equity, anything in general that would be important for people to think about?
Not really, Dominic. You cover so much of it. The private equity word now describes one type of thing, but the private equity world has become so large and so sprawling. It's so much different than it was years ago. It's at one point, very few law firms, very few advisors worked with private equity. Now everybody works with private equity in some sense. In the private equity community, to its credit, at one point was reflected in sort of some very tough, very driven New York type people, very aggressive, and now it's sprawling and it's everything. It's good people, it's bad people, it's a pleasure, it's sharks, it's not sharks, it's truly a business area.
Yeah, no doubt about it. No doubt about it. And so, Scott, just as a recap, so you've got a couple of podcasts going on right now. You're still doing your Becker healthcare review. I mean, you've got a lot going on. So, just to recap, you've got the private equity podcast, Becker's private equity podcast. You've got a business podcast, right? Becker's business.
Yeah,
podcast?
I would say we spend the vast majority of my time in two areas. At Becker's Healthcare is a company I founded 30 years ago.
Yeah.
I've got a magnificent CEO who really runs that company day to day, but I spend a ton of time intersecting with the healthcare community day in, day out. Probably do several podcasts a day in the healthcare community and just very connected to that world.
Yeah.
The second area where I had started our healthcare private equity conference 15, 18 years ago in the law firm McGuire Woods, I do separately a ton of private equity podcasts. And then I would say sort of as ancillary to that, we do some core business podcasts. We do some, business updates that just keep me sharp and knowing what's going on in the world versus anything else. But people listen to them. So God bless them.
Yeah. Well, I always think this every time I see stuff that comes out from you. The world is better with Scott Becker around, and really appreciate you taking time to join us here today.
Well, Dominic, we're a huge fan of yours, so we appreciate getting a chance to visit with you. Always a pleasure. Thank you.
Thank you so much, Scott. I hope you enjoyed this episode. All of today's information will be available in the show notes. If you enjoy our content, please remember to subscribe and review our podcast. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.